microphone is yours.
Thank you, Chris, and I appreciate everybody that's jumping on here and everybody that's going to watch it in the future as we record these on our weekly educational webinar series that we started about 3 or 4 months ago. So if you're looking for a topic and looking for some help in the insurance industry, then take a look at those or contact us and we'll get you hooked up with one of the short and sweet webinars that we're doing for information. So with that being said, my name is Keelan Johnson. I am the sales manager here at Penny Insurance. I've been in the insurance business about 25 years. And so as it relates to this specific webinar, I spent 7 years as a manager for a final expense carrier, which is a whole life. So it's near and dear to my heart. And so here we go. This is a topic I think that everybody somewhat knows about, but it is always important to bring it up, especially to certain clients. So we'll get started here. Before we start here, I want to just go through what we actually do here at Penny. Call it the Penny process. So any agents that come on board and they're onboarded with us have opportunities here to really sharpen up their skills or their products or their processes in many different pillars. Life insurance being one, annuities, long-term care, disability, and now we have an advanced market team. So anything that you're missing, anything you need in one of those pillars to add to your business, to sharpen your business, we'd be glad to help. In addition to that, we have a huge support system in the back office, and this just kind of shows you what it looks like as an agent with Penny. You've got basically on the administration side, we have our own underwriter, and we have our own illustrations team, which helps out package basically up the policy to make it look sharp when you do present it to your client. We have Insurio, which is our in-house built process to process the application simply and quickly. And then once that goes into our Insurio platform, then we have the applications team, which is very knowledgeable, a lot of years of experience inside the application team that really crosses the T's and dots the I's and makes it look nice before it goes to the carrier. And then once it goes to the carrier, we have the case management team, which does a super job on their end too. So your hand is held every single step of the way, and we want to make it easy for you and easy for your client. So the topic at hand today is whole life insurance. A lot of words and a lot of talk going around the industry about term and about indexed universal or guaranteed universals. But still, a lot of the industry is still built off whole life, and you'll know why after this if you don't already. But I want to just give you, I'm going to keep some of these things short and sweet, but I want to give you some terminology today. So if you do have, and you are in the insurance business, you may want to write a few of these things down when you're talking to clients after hours, on the weekends, whatever, because this is a very, very important part of the insurance business and can be a very important part to your financial plan and retirement. So let's jump in here a little bit. What is whole life insurance? If you see the turtle on the right climbing the money ladder, that's pretty much kind of the picture of it. So, permanent life insurance, which means it's there. It's not just term and goes away. It does have fixed premiums, which helps out in a fixed environment, such as your income or your budget. There's guarantees in it. You'll hear the word guarantee many times a day, and that's what a lot of people love, is there are guarantees, which some of the other policies don't, but whole life does. Guaranteed cash value growth, which is important too in the financial plan and in the realm of a life insurance policy. Let me go back here on that one a little bit. Yep, I'm going to go forward here. So term insurance. So what is term insurance here? Term insurance is temporary coverage. Okay, it covers you for a period of time, 10, 20, 30 years. It is a little lower cost initially because it only covers you for that amount of time. There's no cash value built into term insurance. So it's just the coverage, and that's what you get. With whole life, it is permanent coverage, which means it goes your whole life as long as you're paying premiums. And it builds cash value, and there are guarantees built in, which you'll see shortly. Just a few little stars here on what it is and what it isn't. Term is you choose your policy length, 10, 20, 30 years. Whole life goes your whole life. Term insurance does not provide lifelong coverage. Whole life does through your whole life. Term insurance premiums stay the same. Whole life premiums stay the same. Term insurance does have lower premiums only because they're covering you for a certain amount of years, and whole life is for your lifetime. Death benefits remain level. The death benefits do remain level. In one case, you're going to see in a little bit, the death benefit does go up because of the extra additional premiums that are put in by the company. And also on the bottom, term insurance does not accumulate cash value. Whole life does. And also whole life has dividends, which comes from the company to help you out. And we'll see that shortly. Whole life, just another chart here that looks this way. Again, you'll see term is the blue line here. Once your premiums stay the same until a certain age, and then after that, it becomes what's called an annual renewable term, which means the premiums go up. So if you outlive your term, prepare for increased premiums. And most of the time, in that case in point, people drop the policy, which leaves you at a later age and maybe less insurable and higher premiums at that point in time if you don't lock it in low. Whole stays the same all the way through the lifetime of the policy, which is great for some people. Some pillars here, just some words here. As you see the picture on the right, there is so much stability in a whole life policy, so many guarantees. As you said, as I told you before, you'll hear the word again over and over, and it is great for long-term planning. Not short-term planning, but long-term planning. So that's kind of the basis, as you can kind of blink your eye and look at that. Stability means this. So you have predictable premiums. The premiums stay the same throughout the policy. Consistent cash growth through the policy. So it does grow, as you see on the right. Less impacted by the market volatility. So when we talk about that, we talk about a whole life being built on chassis of CDs and bonds, which do not fluctuate to the degree of the market space. So there is less impact there. And then again, long-term financial foundation for the end of life and or throughout life. Okay, so just think of those words as you're talking to your clients, as you're out there amongst them, ask them about if they've ever considered a whole life as an option. Guarantees, this is the important part, whole life goes along with guarantees. You're guaranteed your death benefit again. You're guaranteed your cash value growth. You're guaranteed your premiums that go throughout the policy. So you don't have to worry about that. You can sleep at night. And contractual certainty, which means there will be a contract at the very end and you will get that death benefit. And or if you choose the cash, that can be an option too. Why is it important for long-term planning? So if you're looking at long-term planning, you want something to go through the rest of your life. You want to protect your estate. You want to, maybe access some of the policy cash value in the future. And we won't really get into that too, but a little bit of that where you can borrow against your money and keep your interest rate going. And if you've got an estate, if you've got, an estate or a legacy you want to leave, is very good for that because it's always going to be there at the end of life. Your whole life policy will. So once you set it into play and set it into place, you can sleep again at night knowing that it will always be there on the whole life side. All right, go back one. Let me see if I can run back one here. There we go. So whole life final expense, and this is a subject where it's near and dear to my heart because I had a lot of agents that were protecting a lot of people at final expense. So if you do get around a client, maybe they're older, maybe they're on fixed income, maybe it's you trying to protect your mother and father, maybe it's burial cost and that they don't have. Lots of times we find people in the final expense kind of realm in the age of 50 to 70, maybe up to 75. Again, we have all the carriers you would need for that specific purpose. It does cover the cost of the funeral and burial. And this isn't a final expense webinar, but we do have one there. And again, it's, sometimes upwards of $13,000, $14,000, $20,000 to do a nice funeral these days. And the cost is always going up. So we don't want somebody to come out of pocket, the kids. We don't want the family to come out of pocket. And again, it keeps the premium down because a lot of the final expense face amounts are $20,000 and $30,000. So it keeps your premium where it's affordable for people on fixed income. And don't forget, if you're in your 40s or 50s like myself, and it is something you can buy for your parents. And so, or yourself or anyone in your loved ones. So talk to your advisor, talk to your agent, talk to us on how we can get that. And it leaves a legacy. I mean, I heard before, I'm going to get off on a little tangent, but when somebody passes away, and I'm sure everybody on the line has had this happen before, either in a good way or a bad way, that someone didn't think to cover their expenses and you're having to write the check. And not that you wouldn't, but it sure makes it a little harder when you're having to come out of pocket and you're getting that funeral planned, and you got to think, well, I don't know if we want to do this or that because we don't have enough money. It does leave a legacy and a little impact on the family at some points in times. It's guaranteed coverage, so you're always there. It's always going to be there, no matter what. Long as you're accepted, once you're accepted, they can't take it away and can't pull it out from underneath you. So it's always going to be there. And again, builds cash value. So at any point in time, let's say there was a tragic moment or whatever, you are going to build some cash value in here. So it's not one of those like a term, and term has their place, but you're not just throwing money into the wind. You're building a value within your policy. Okay, so that's what's important there. Next slide, we're going to go to participating. So some of the mutual companies out there that we have are participating whole lives, which means they pay dividends. So every year, if the company has a successful year, you're going to receive dividends, and you can actually place those dividends into more death benefit, or you can place those dividends into your cash value. And you'll see an illustration about that, in just a moment. But if you look at this little chart right here, it's with compounding interest and without. So with compounding interest, all of y'all know financials, as you grow the money and as it gets bigger and it grows exponentially because you have compounding interest in there, which is tax-free money that's growing inside your account at the current interest rate. So the longer you leave it in there with that compounding dividends, has a greater chance of really ramping up, as you see in the illustration. Again, you can have increased death benefit, and it is long-term compounding interest, which is a great financial word that people love. Here's an example right here of the cash value on a whole life policy. If you see at the bottom, when all of y'all have seen illustrations before, you see a guaranteed, a non-guaranteed midpoint over here, and then on the right, that is current. So for those of y'all that haven't seen one of these, the left is the worst case. I did that again. I'm using my mouse too much. Get over here and try to go back. The left is the guarantees that you'll have. So you'll see there is a guaranteed cash value to reach 100,000 at the time, of course, age 121. But you see that guaranteed cash value that is guaranteed, it creeps up on getting almost exactly right with the amount of premium you have that's guaranteed. Now, the non-guaranteed midpoint basically means that this is based on current interest rates. This is based on the past 10 years of a carrier right here. And if you see there, if you'd have had a policy, this policy right here, and put this amount of money in there, after 20 years, you would have a cash value of 55,000 and a death benefit of 120,000. And then on the right is what it has been doing, assuming the midpoint is current interest rates, but also they could raise policy fees. On the right is what they have not been doing. This is exactly what these people would have in their account. If they left it in there till 85, you can see on the left, they'd be paying $97,000 into this policy, and they'd have 190 in cash value. So that's what dividends does for you. And then a death benefit of $238,000. Okay, so they've 2.5 times their death benefit, and then they have the cash value that they can use for whatever they want to, which is important to a lot of people. So this is actual dividends from some of our carriers right here, so that there is proof in the pudding, so to speak. In 2020, you see Mass had a 6.2% dividend rate. Mass had a 6.0, a 6.0, and a 6.0, and it's projected in 2025 to 2026 around 6.5 to 6.6. So when you think about interest rates, you think about what you're putting your money in, you think about where your money is located. What a better thing to have in a life insurance policy, and something that is getting dividends and interest rate to pad that for your next 20 years of life or 30 or what it may be. So that's why it accelerates so well, and why a whole life policy sometimes outperforms every other policy that's out there, depending on the years you're in. So who is whole life good for? I mean, several people. I mean, you've got your families, number one, to protect the wealth, build generational wealth, plan for education, and leave some legacies. If you've got business owners out there, it can protect your business. You've got succession and exit planning in there also, from a business owner. Key person and buy sell. A lot of people are using that. If you have businesses for key person or buy sell agreements where you say, hey, I've got a key man, and if you stay here with us 20 years, we're going to protect you and we're going to protect ourselves. And also, if you're here, we've got cash value to pay you, maybe as a bonus at the end of your retirement. And that's a very, very important to those type of people, and looks good on paper, and they love it. The business owners do. High income earners over here. You've got the people, the wealthy, for tax planning. So when you talk about taxes and estate taxes that they're going to be handing down to their kids, and you have a life insurance policy built into your estate plan to where they can take that that death benefit and pay off the taxes that may be owed from the estate. Very important there on that real. Conservative savers, a lot of conservative people out there that don't trust the market. They don't trust how long they're going to live, and this is very good for them because you can show them the illustration and show them the guarantees that they're going to have forever and ever. And not only that, the whole life policies stay on the books for a lot longer, because once people start building cash value in there, they don't want to get rid of it. They want to continue on with it and grow it because they've already got a nest egg started and they don't want to start over. And then legacy. So for legacy, focused on the clients, leave a legacy for your family so that when you are gone, that the family knew you cared, and you took care of business. So that's important too. Business planning, again, you see the business here, and you may have a couple of people in there that are key people in the back of this organization, or you may have two brothers, or maybe a family or a cousin. Buy-sell agreements are very important too. We won't go into that in this webinar, but as the business gets ready to, on a buy-sell, it's very important that they put these things into place as they move forward so that the business can continue to operate. Key person, you lose that one good guy or one good girl and they're gone. It takes money to find a new person, to recruit a new person, to train a new person, to put them in the seat. So there has to be some money that's going to be out of pocket for the company once this happens, and that's what it is. Executive bonus plans, if you have some good people in there and you want to bonus your executives for some extra money to keep them around, to make yourself different from another company. That's what that's doing too. And business continuation plan, to where at the end of someone's life, there's money there to continue the business so that you don't have to close the door because they're not there. Okay, so that's very important too. Common objections that we get: it's too expensive. It can be more expensive and is more expensive than term insurance. And you get what you pay for, so if it's too expensive, then you're welcome to you transfer over to a term policy and switch gears and go, well, I'll tell you what, I can give you a term, but it's not going to perform like this is. And you're buying an investment along with a life insurance policy. You're buying that security along with a life insurance policy. So you can pivot over to a term, but again, that kind of covers that objection. I can invest better somewhere else. You know what? If you think you can, go ahead. But I don't know, in the long term, carrying 6, 7, 8% interest rate over a long term, over a 20-year, you have the market fluctuations. So, if they think they're an investor and they can do it somewhere else, then, might be time to let them go. But you've shown them what you have, and leave them the illustration, because they'll go home and think about it and come back. You know what? I think I might, that might make sense. And I only need term. Did you know that you can tell this out loud too? Only right at 3 to 4 to 5% of term policies ever pay their death benefit. And that is the truth. So 95% of term policies never pay death benefit. So because people outlive them, they buy too short of a term, they outlive them, and then the price goes up. And so, that is the old adage, buy term, invest the rest. But the realization of it is, only about 15% of the people ever do that. So that you can come back with overcome that with objection easily. Whole life complements a broad financial strategy. So that's what we're kind of talking about here today. Final thoughts. I'm going to get wrapped up here. And I know it was a short and sweet, but that is what whole life is. There's not a lot of moving parts, which makes it very attractive to people. There's guarantees, which make it attractive. It's stable and it's predictable and it has long-term value. So as you're talking to your clients, and that's important to them, they're 40, 50, 60s, or whatever, and they want to leave legacies, and they want something that will be there for their family, and they don't want to worry about it. They want to put it in a sock drawer and it be there forever and ever and ever until they pass away. That is what we're talking about here. Okay, so that's the stability of a whole life policy. And again, we internally can put illustrations together no matter who you've got, what age, what demographic, doesn't matter. You know, at $5,000 they want or $500 million, we can do this with our carriers. We have a great internal team that can put that package together for you, where you can present it to your clients and look like a hero for sure. Okay, and then my favorite terminology is "let's go protect." So that is my favorite terminology on there. And let me jump that off real quick. So as we do that, let's go protect. I like to think of it like this: we don't sell insurance, we serve people. Okay, so if you're in the business and you like serving people, and you want to help people out, that's what we do, and that's what we're here for. Okay. So don't forget, though, too, with Penny, we have multiple pieces of the pie here that you can access, that we can access, and is available to you. We have the back office. We have retirement solutions from our in-house financial advisor. We have our own underwriters here. We have our own CRM that you can use, business owner exit planning, estate planning, and an outsourced life sales team that we can use and you can use also as we go through here and fit the needs of our clients for sure. And Chris, that's kind of it. And my name is Keelan Johnson here. You can contact me any way you want to over here on this side. And if I don't know the answer, I will get you hooked up with the people that do. We will get you taken care of. If you're not onboarded with us, you're welcome to. And email me later. I'll be glad to take care of you. And or if you know any other advisors or agents that are looking for some platforms and support in one of those life, annuity, long-term care, disability, or advanced market spaces, we can do that. You don't have to have all of us. You can have a piece of us. We'll fill in the gaps, and then we'll be there for you to make your back office stronger if you're missing one of those pillars. So with that being said, I think I went maybe 23 minutes. I saved about 6 or 7 for some answers or cut you short. But thank y'all for joining on here. That's Whole Life, a part of our educational webinar that we do every Thursday at 2 o'clock Central, which I'm in Central, if you can't tell by my accent, in Texas. So anyhow, thank y'all for that. And if you need any resources or help or support, we would be glad to help you out.
Yep. So we have a few questions that came in. The first question is, how can I use Whole Life to deepen my client relationships?
Well, so that's a good question there too. I mean, when you talk about deepen relationships, we're talking about trust. We're talking about caring for families, and trust. So that is part of the whole life process and the final expense. You've got to form that relationship with them, because as you sell whole life, you may have some tough questions that come up about, well, tell me about your finances, tell me about your family, tell me about, your health, tell me about your income, so that we can tailor this to you. So it's not just a cut and dry, I need $100,000 worth of 10-year term. We're talking about getting into their so as you deepen that relationship, that comes across as trust. It comes across as care. It comes across as that they really want to do what's best for my family. So it is a great way to deepen your relationship with your clients, because you learn more about them and you're finding out about their family and their true needs, which is personal to them. But if they trust you and you're their trusted advisor, then that makes it pretty deep.
And the next question that came in, what has been the biggest factor you've seen that helps agents increase both case size and client retention over time?
So that's a good question. Client retention, I'll take the backside of it. Client retention is nothing but relationships, annual reviews. That's one good thing about, on the whole life and the life insurance side is once you gain their trust and it's a deepened relationship there, you have their phone number and their email address, and you can send them birthday cards. You can go by and see them. You can call them every year and say, how are things going? You can tell them what their cash value is doing. So many ways in a whole life policy that you can make people smile, if you know what I mean. So that, and then you have the opportunity, and we always, after a certain period of time, go, hey, by the way, who else do you know? Because here's the thing, in whole life insurance is like final expense. There's a 100% chance that everybody's going to die. And as long as you're paying your premium, there's a 100% chance the policy is going to pay. So if you're there for those people and they trust you, you have a plethora of referral options, to and to grow on with their friends, their family, their people. You give them your business cards. Who else can I talk with? Nobody's going to turn it down because they all want to protect other people too. So a whole life can be as small as something $10,000 or $15,000 on a kid. I mean, we've sold whole life policies for kids that are 2 years old, because when they're 18, they have cash value and they may use it as a gift or a college fund or whatever it may be. So there's another benefit there. The case size, Chris, is you got to be cognizant of their income. We always had to do that in the final expense. And any time you're in life insurance, you got to be cognizant of their income, because the last thing you want them to do is cancel that policy, and not have enough money. So we always talk about, hey, everybody wants a large face amount, but you need to be cognizant of like what fits in your budget. And hey, you almost have to sell yourself out of it and say, hey, if we write this policy, you promise me you're going to keep it, because I want you to keep it. That's my goal. If I had to go to your funeral one day, I want to be the advisor at your funeral, not the one in the back pew back there going, hell, I didn't talk to him, or I didn't talk to them. And that's a little deep there, but that does. But you can, I mean, if you show them the value and show them what their money can do potentially, they will find coffee cans full of more money to put in there. As long as you show them the value and what engine's running behind it, they'll kind of dictate their own value and their own case size.
And looks like we have one last question. When is a good time to introduce whole life to my clients that have term?
So that's a good question too. If they have term, look at their term. If it's a 10-year, 20-year, or 30-year term, I mean, so here's the thing about it is, everybody, is that the average age of death in America is 77. Okay, it's 77. So if you take a room full of 100 people, this is just average, I'm not making this up, 50% on average are going to be passed away by 77. 50% will live past 77. The scary part about it is the people are living past 77. You got to have younger people pass away to offset that. So if you've got somebody in their 40s or 50s or whatever, and they've got a 10-year term policy, you may think, hey, listen, I hate to tell you this, but, good news is you're probably going to outlive this policy. There's a good chance. And then once you get to be 67 or whatever, you'll have zero. You won't have anything. So even at that point in time, if I don't know if you have a convertible term or whatever in the 40s and 50s and even the 60s, maybe a good time to think about, hey, let's at least get you something that's going to be there till the end, all the way through. So that's a really good time to talk to them. If you're doing final expense, you can talk to them in their 60s, and get them a smaller whole life, final expense policy. If you're doing wealth planning or anything on the business side, anytime is good to talk to them if they're business owners, even if they're young or old. So it's always just a topic of conversation as your stuff, you've got term, you've got whole, you got IULs, and there's beauty on all of them. Don't get me wrong, but the whole is the bread and butter. It's more of a warm sell because you're taking care of their family, and they're going to love you later on for either their family will or they will for putting that into place. So every time, I mean, you talk about people, oh my gosh, we didn't know that dad had this policy. We didn't know that mom had this policy. Or, oh my gosh, we found this policy. Thank goodness we did, because we were able to cover these things. So it's more of a personal touch, but also a very strong, policy to write for people and be involved with. So, again, I would always challenge you to sharpen up your whole life pitch, because it will make people happy. You'll have happy clients. You'll have better retention. And that premium will be there, and the commission is good too on a whole life. So that's good news too for the advisors. So yes, hope that answered the question.
Yep. And those are all the questions. Any closing thoughts?
No, I just want to thank y'all for being here on the line. Thank y'all for, hopefully trusting in Penny. And as we grow, we want to support you as an agent and your clients. Again, reach out to us for anything. We are here to be your back office for anything you need on the pillars and support you. We have a great staff and a great carriers too that we work with. We know all the carriers, so it's all there, y'all. So if you're looking to sharpen it up or add a piece to your business, reach out to us at Penny here. And again, we protect lives and we serve people.
Well, thanks everyone for joining, and we'll see you next time. Take care.
Thank y'all. Thank you, Chris.